Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. It's a big episode today, so let's jump in. And first up, we begin in Europe. NATO member states are moving toward a historic agreement to significantly increase defense spending, aiming to align with US President Donald Trump's demand that each ally dedicate 5% of GDP to military and defense-related expenditures. Diplomats say the goal is to finalize a roadmap ahead of the NATO summit in The Hague in June. Negotiators are making headway in a two-tiered target, 3.5% of GDP devoted to core military budgets and an additional 1.5% for broader defense-related areas. These might include cybersecurity, dual-use infrastructure, military mobility, and possibly aid to Ukraine. The proposal, spearheaded by NATO Secretary-General Mark Rutte, would represent the largest military spending increase among Western allies for decades, indeed since the end of the Cold War. The plan is expected to feature prominently at a meeting of foreign ministers in Turkey this week, as momentum builds ahead of the summit. US President Trump, set to attend his first NATO meeting since returning to the White House, has reportedly criticized allies for falling short of their financial commitments. As of NATO's latest annual report, only 24 of 32 members were on track to meet the current 2% GDP benchmark, long a source of transatlantic friction. Trump's administration has linked higher spending to broader strategic aims, including strengthening NATO's deterrence against Russia and lightening America's disproportionate burden. The US currently accounts for 64% of NATO's defense spending. European allies and Canada make up the remaining 36%, despite the fact that the majority of NATO countries, especially those in Europe, are developed like the US. The expanded framework would include a formal verification mechanism too, marking a departure from previous informal guidelines. Dutch Prime Minister Dick Schoof confirmed last week that Rutte had sent letters to NATO leaders outlining the 5% target and calling for a new approach to ensure equitable burden sharing. Still, reaching these levels within the proposed timeline by 2032 presents major political and fiscal challenges. Quote, boosting spending by this magnitude will be an enormous lift, end quote, said one senior European diplomat speaking to US-based Politico, adding, quote, but the strategic imperative is clear. We must send a message of resolve to Moscow. End quote. Defense ministers are due to meet in Brussels in early June to finalize capability targets, classified lists detailing weapons systems and operational capacities NATO deems essential. These targets are expected to be endorsed by member governments ahead of the formal Hague summit. Meanwhile, Trump's reluctance to support Ukraine's accession to NATO has kept the issue off the summit agenda. Talks around renewing NATO's $40 billion Ukraine aid package have also stalled. Instead, the summit will center on spending, military-industrial ramp-up, and internal reforms. The Hague meeting will be shorter than past summits and is expected to conclude with a concise declaration, but its implications may prove long-lasting as the alliance recalibrates for an era of sustained geopolitical competition. And if you want to be on top of all the most up-to-date and salient developments related to this new competition, which is transforming our world by the day, consider subscribing to Market Update, hit the bell notification icon, and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. We move now to Asia. Japanese automaker Nissan Motor announced this week that it will cut 15% of its global workforce, around 20,000 jobs, and shut 7 of its 17 factories as part of a sweeping restructuring plan to turn around its struggling business. The move, announced by new CEO Ivan Espinosa, comes as the automaker posted a net loss of 670 billion yen, $4.5 billion for the fiscal year ending in March, one of its largest ever. The restructuring includes consolidating operations in Thailand, shifting production from Argentina to Brazil, and reassessing assets globally, including in Japan. Nissan also plans to reduce fixed costs by 500 billion yen by March 2027, simplify its supply chain, and explore exporting vehicles from China. Espinosa called the results a, quote, wake-up call, end quote, citing high costs, weak demand in the US and China, and impairment changes across several regions. The company will not issue a profit forecast for the current fiscal year due to ongoing uncertainty around US tariffs. Honda, meanwhile, another Japanese auto giant, warned it faces a worst-case tariff-related hit of 650 billion yen, driven by President Trump's 25% import duties on non-US built vehicles. These are in the billions of US dollars. Nissan expects a 450 billion yen, approximately $3.5 billion US dollar impact, and aims to offset it by boosting local production. Espinosa said Nissan remains open to strategic partnerships, including with non-automotive firms, as it seeks to manage the rising cost of electrification and smart driving technologies. While merger talks with Honda were abandoned earlier this year, discussions around joint projects continue under an existing strategic framework. And to end today, we move to North America. A furious rebound in US equities and other risk assets has blindsided institutional investors as the surprise détente between Washington and Beijing triggered a wave of position unwinding and bullish market momentum. The S&P 500 has surged 4% this week, raising all of its 2025 losses after the US and China agreed to sharply reduce tariffs for at least 90 days, which we covered earlier this week. That agreement, seen as the beginning of a potential end to the trade war, or at least the worst parts of it, sent shockwaves through positioning in global markets. The dollar initially rose alongside equities, while US Treasuries sold off, sending yields higher as investors exited defensive trades. The 10-year Treasury yield jumped to 4.5% from about 4% in early April, signaling a sudden shift in sentiment around economic growth expectations. Quote, "I think the market got caught quite offside," end quote, said Robert Tipp, head of global bonds at PGIM Fixed Income, speaking to UK-based The Financial Times. He noted that recent policy climb-downs, to use his words, forced a dramatic reassessment by investors who had been positioned for continued economic turbulence. That repositioning has especially hurt hedge funds and large asset managers, many of whom were holding bearish positions in US equities and the dollar. Bank of America's latest fund manager survey, conducted before the tariff breakthrough, revealed the most negative sentiment towards US stocks in 2 years and the most bearish outlook on the dollar since 2006. Quote, "Essentially every thematic macro trade of the past few months is going the wrong way," end quote, said a Japan-based Nomura analyst in a note. Retail investors, in contrast, appear to have capitalized on the dip. Deutsche Bank noted that the S&P 500's recent gains have mostly occurred during regular trading hours, when amateur investors are most active. By contrast, overnight sessions, typically dominated by institutions, saw muted returns. The technology-heavy Nasdaq Composite has led the rally, soaring nearly 30% from its April lows, when President Trump's Liberation Day announcement of sweeping reciprocal tariffs rattled markets. That chaos has triggered a sharp pullback, leading many institutional players to de-risk and move into cash. Market volatility has collapsed amid the rally too. The VIX, Wall Street's fear gauge, is back to levels last seen before the tariff shock, and CME data shows that expectations for swings in the euro-dollar exchange rate are at their lowest since March. Still, many analysts warn that the rally may be overextended. Andrew Pease, chief investment strategist at Russell Investments, cautioned that investors should not ignore the underlying damage caused by months of policy uncertainty. Quote, "We should remember the policy chaos damage to consumer and business confidence before getting too optimistic," end quote, he said. While Trump has hinted at further tariff relief, doubts remain about his ability to enforce or unwind the policies without congressional support. In the meantime, Wall Street's short-term euphoria is colliding with longer-term uncertainties, both economic and political. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Thursday. I almost forgot the day. Have a good Thursday, and I will see you all tomorrow.